Hi, good afternoon, everyone. We're going to get started, just in respect of everybody's time. Welcome back. Once again, my name is Jerome Franks, President of CFA Society of the Bahamas. Thank you all for joining us again this evening as we continue our financial literacy series. Last week, we would have discussed savings and budgeting. And naturally, the discussion led into investments. Of course, if we have extra cash from our saving and budgeting, we want to figure out a way to put it to work, right? So this evening, we will be joined by Lachelle White, who is a fellow CFA charter holder and member of the CFA Society. And she will be discussing the topic investing, wealth building strategies. Okay, so as usual, please feel free to ask questions. You can use the Zoom chat feature and send your questions to the host, or you can raise your hand and you can ask your question directly to the speaker. So before introducing Lachelle, it is our protocol to briefly introduce our society. As we never know, we may always have somebody new on the call with us. So just briefly, CFA Society of the Bahamas is an organization of financial and investment professionals, generally hold or are pursuing the Charter Financial Analyst or CFA Charter. For more information on the society or the CFA designation, please visit our website, cfasociety.org/Bahamas. So now please allow me to introduce our speaker for this evening, Lachelle White. She will be discussing the topic investing, wealth building strategies. Lachelle White joined CFAL in October 2008 as an investment manager. As a member of the CFAL investments team, Lachelle oversees the management of discretionary and advisory portfolios. In her role, Lachelle reviews clients' stated investment profiles and constructs and manages suitable investment portfolios that will meet their short and long-term goals and objectives. She also serves as a member of CFAL's investment committee. Lachelle has over 16 years of experience in the financial services industry and holds a bachelor's in economics and finance from the University of the Bahamas. She received her Charter Financial Analyst designation in 2009 and has previously served on the board of the CFA Society of the Bahamas, of which she remains an active member. We welcome you, Lachelle, and thank you for joining us here this evening, and I'll hand it over to you.
Okay, thank you, Jerome. Good evening, everyone. I'm excited to be here this evening to present to you on the second session of this year's financial literacy series. So today we're going to talk about strategies for building wealth. And first, we will look at the importance of building wealth. And next, what steps you should consider before you start investing. And then I will share a few tips on how to determine your risk tolerance. And this is a very important step for all investors. And then we will get into the heart of things and look at the various strategies for building wealth. And this will not be an exhaustive list. You may think of some other things, some other ways that you can build wealth through savings and investing, but this is just a short list that I put together to share with you. And because it is so important, I included a separate slide on debt management, so how to manage debt properly. And then I will also discuss the various investment vehicles that are available to you to help you in your journey for building wealth. This is not going to be a complete list. It's always important to think outside of the box when deciding to invest and build wealth. And then finally, we will go over the key takeaways from the presentation. And then I will be available to take questions. But as Jerome mentioned, if you have a question during the presentation, please raise your hand. So let's get started. First of all, why is building wealth important? building wealth is important for several reasons. The first one being peace of mind. Building wealth will give you financial security. And so if you have that financial security, you really don't have to always be worrying about money. If you have sufficient assets tucked away, you do not have to worry about what will happen in a financial emergency or if there's some large change in circumstances in your life. So if you lose your job or if you have medical emergency, there's always some comfort in knowing that you have a nest egg to fall back on. Next, we have financial freedom. Building wealth gives you the flexibility to make life changes. You can be comfortable if you want to change jobs, or maybe you want to move to another island or to another country. And then you can even have the capital to make investments in the future, or even now, if you see an opportunity, you can take advantage of it because you have the capital to do so. Next, we have comfort in retirement. In retirement, you can live comfortably because basically you would have spent all your working life building your wealth and building up a portfolio. So your investments will then take care of you and you don't have to worry about money. NIB is unfortunately not going to be enough. It's only going to be a small part of what we need in order to live comfortably in retirement. And lastly, we have legacy. You may want to pass wealth on to the next generation. You may want to leave something for your children and your grandchildren and their children and their grandchildren. So building wealth allows you to build up assets that you can pass along when you are gone. You may also want to start a foundation in your name or give to charity, and building wealth will allow you to do this. Now, I just want to take this time to say that building wealth does not mean you have to be a multimillionaire. It does not mean you have to chase the dream of having millions of dollars in your bank account, but simply that you have accumulated enough assets to achieve your financial goals. Okay, so this slide, before you invest, knowledge and preparedness is key when seeking to build wealth. So before you begin on this journey, remember that building wealth requires a commitment. So first you want to know your goals and look at your goals and ask yourself, why am I doing this? How long do I want to do this for? How much assets do I want to accumulate? What is my end game? What am I doing this for? So you want to ask yourself that, and you want to prioritize your goals. You have to say, do I need to take a big gamble to get where I want to be? And the answer to that is often no. We always say slow and steady always wins the race. Next, you have to determine your risk tolerance. And this is very important, as I mentioned earlier. And a lot of people tend to imagine that their tolerance for risk is higher than what it actually is. But knowing your risk tolerance will guide you on what investments to choose. And this will be, I'll talk more about your risk tolerance in the separate slide. And lastly, you have to do your research. You have to read and educate yourself. Whatever you invest in, do your research, read about it, read the fine print, seek advice from various sources. And this is especially important if you are not an expert. And even if you are an expert, it's always important to read about something and understand it thoroughly so that there are no surprises. And you have to make sure that your investment, any investment that you get into, is in line with your goals and does not breach your risk tolerance. However, I would like to say that you don't always want to solely rely on tips and information from others because their goals may not align with your own. But you always want to be asking questions. I'm not suggesting that you read every financial book or read the Wall Street Journal every day, but you want to be aware of what is going on, current events, what is going on in the world, and how these things are going to affect your investment. Okay, next we will look at determining your risk tolerance. So risk tolerance is the degree to which you are comfortable with the volatility in returns. Most people want to make money but not lose it. I guess that's basically all of us want to make money, but we don't want to lose it. We tend to be very hungry for high returns, especially if we see others making high returns, making all this money. But at the end of the day, we tend to be pretty risk averse, and we're not willing to do, take all that risk to get these high returns. But determining your risk tolerance would be the first step to take before choosing the best investments for your financial goals. So your risk tolerance is affected by several things. So first, we have your investment time horizon. Usually, if you have a shorter investment time horizon, you are able to take less risk, versus if you have a longer time horizon, you are able to take more risk. So for example, we often tell persons if they are close to retirement, you can assume less risk because you have less time to recoup losses. So if retirement is your end of your investment horizon, you don't want to go into risky assets a few months from retirement, because if you lose money, if the market goes down, you lose all that money, you will not have time to recoup those losses. Versus if you had a longer time towards retirement and the market goes down, and we all know that the market fluctuates, you would have time to recoup those losses because you have a longer time horizon. So next we have return expectation. So the relationship between risk and returns are positively correlated. So the higher your return expectations, the higher the risk, and the lower your return expectations, the lower the risk that you're willing to take. So if your risk tolerance is relatively low, then you should expect relatively low returns, and someone who has a high risk tolerance who can expect higher returns. Then we have the diversity of your investments and your degree of wealth. If you have other investments that can provide income or assets growth, then if one investment fails, you can always rely on another investment to earn you money. But if one investment fails and that's the only investment, then you could potentially lose all your wealth. So if you have a diverse group of investments, then you are usually able to take more risk. And also your degree of wealth, if you have more capital, you can take more risk. So let's say you have a $10 million investment portfolio, and someone comes up to you and they want you to invest $100,000 in a fairly risky, which you could describe as a fairly risky investment. You may be able to take a chance because that $100,000 is like 1% of your total assets. But at the end of the day, your risk tolerance also boils down to your willingness to take risk. Are you willing to put your capital at risk? So your willingness versus your ability to take risk. And there can usually be a mismatch between these two. So it always boils down to how comfortable you are with risk. You could have the capacity to take on a lot of risk, but simply don't want to. So going back to my example, if you have the $10 million in assets and somebody comes to you with that risky investment, you just may be like, oh no, I'm comfortable with my portfolio of bonds and preference shares or whatnot. They're giving me a steady return. I don't feel like putting any of my capital at risk. So at the end of the day, it always boils down to how comfortable you are with taking risks. Can you sleep at night knowing that your capital is at risk? Or are you just happy knowing that you can get a higher return if you can take a higher risk? And also, when determining your risk tolerance, ask yourself, what is the priority of your goal? If you set out and you want to increase your wealth, accumulate wealth over time, increase your investment portfolio over time, you will not be hasty to go into a risky venture and take a big gamble in the short term just to get a quick return, because you know that you have a long-term investment horizon and you're willing to wait to accumulate your wealth. Okay, we're going to start to look at the various strategies that you can undertake for building wealth. But first, I just want to share this slide, which I think pretty accurately represents just a basic cycle for building wealth. Building wealth requires a consistent and disciplined approach. And so basically you want to earn, and you can make your money via salary, or maybe you have some rental property, which is an investment, a rent receipt, or any other income. So you want to earn. Once you earn money, that money that you don't have to spend to fund your lifestyle expenses, you want to invest that money. And you want to invest the money in investment vehicles, suitable investment vehicles that are suitable for your goal. And once you invest that money, you want to accumulate. You got to watch your money grow. And maybe your money is growing because of the income that you're getting from your investments, or even the capital gains. So at this stage, when you're accumulating and you're growing your money, you don't really want to touch your money other than for basic living expenses, or maybe sometimes you want to treat yourself. You know, you never want to leave yourself out, but you want to watch your money accumulate and try not to take out any unnecessary expenses. And then we just want to repeat the cycle all over again, keep repeating it until you reach your goal, or maybe you repeat it until you die. But these are just basic earn, invest, accumulate, and that cycle should continue once you start on your journey to building wealth. Okay, so we're going to start with the various strategies. So first, you want to pay yourself through savings. You want to aim to make savings a priority and save as much as you can. So try to save as much as you can and invest your savings wisely. So once you invest your savings appropriately, you're basically putting your savings to work in a manner that is in line with your financial goal. Remember that money is not going to grow, or assets are not going to grow if they're sitting passively. And in the current times, you know, we are in a period of very high inflation, and inflation has gotten very high very quickly. And so if you just have your money sitting in a savings account, and you know, nowadays interest rates are very low, so you're probably getting 0 to nothing on just paying fees for the bank to hold your money. So your money is not going to grow if it's sitting passively. You want to grow your money at least at the pace of inflation, to fight inflation. Otherwise, your money's value is going to appreciate over time as things get more expensive. And you also want to diversify your investments and develop multiple streams of income. So you want to invest in various vehicles that can provide you with earnings. So we are all familiar with the saying, don't keep all your eggs in one basket. You know, you all drop that basket, all the eggs are going to crack, and you'll be left with nothing. So you want to invest in different companies and different asset classes. Basically, you want to have a wide range of investments. And so having various investment means that if one fails, you will not lose all your wealth. And you want to have investments that grow over time. And remember, returns can fluctuate over time. It's also important that you invest in vehicles that can provide you with a steady stream of income. You can then reinvest this income, and we'll talk about that in the next slide. But once you invest in various vehicles that can provide you with a steady stream of income, basically you're getting this sort of earnings that you're not really working for, but your money is working for you. So reinvest your earnings. You want to compound your returns by reinvesting earnings from your investments. Whatever you earn from your investments, keep it in motion. Keep your money consistently in motion. So this is how your wealth will grow. So remember, I mentioned earn, invest, accumulate, earn, invest, accumulate. So you do not only have to invest the income that you receive, say you receive interest payments from bonds, but you can also reinvest capital gains by taking profit on your investment. So if you have an investment that goes up 20%, you may decide, oh, this is the time I want to, take some gains on this investment, and you can reinvest that in another security. You want to also track your investments regularly. You want to be organized and keep a list of assets and monitor their performance. Remember, growing wealth will require some effort, so you just don't want to have investments here and there and everywhere, and you have no idea how these investments are performing. You have no idea what they're doing. You have no idea when you receive the last update on them. So you want to keep a spreadsheet or a folder of your various investments. And you want to say, when did I get into this investment? What return did this investment give me? And this is, some people may have, you may have a brokerage account or a mutual fund account, and that's easy because you're provided with regular updates. But if you just have private investments, you want to make sure that you keep track of them and know what you are in at all given times. Now, this doesn't mean that you have to watch your investments every day. That could possibly, drive you crazy if you see something go down $1 or whatnot. But you want to keep a regular, you want to do regular monitoring of your investments, and that will allow you to ensure if an investment is doing what you expect it to do. And when you can see what is happening with your investments, this can mentally help you to reaffirm your commitment to growing wealth, because you're like, okay, these are my investments. This one is doing really well. I made a really good bet on this one, or this one not so much well, and I can learn from this. What can I do the next time? So tracking your investments is all a part of your commitment to building wealth and building investment portfolio. Next, you want to invest in yourself. Building wealth requires a constant investment in yourself. So you always should be seeking to improve your knowledge, and you should always be mindful of your physical as well as your mental well-being. Now, when I say invest in yourself, I'm not talking about buying fancy clothes or going to the spa every week. I'm just referring to your knowledge, your health, your happiness, your overall well-being. Remember that, there's a saying, health is wealth, and wealth is not only defined by financial success, but also by your physical and emotional well-being. So you should ensure that you are taking care of yourself, and because it really makes no sense to chase wealth if you are unwell. Okay, on this slide, manage debt, very important. You want to keep your borrowing at a minimum and avoid unproductive debt wherever possible. So I talk about this in more detail on a separate slide, but basically, if you are constantly paying off debt, it is reducing your ability to save and invest. So remember, by saving and investing, you're paying yourself, you're building your wealth. But when you have debt, you're paying someone else, mostly the bank, you're paying those hefty interest payments. So you're not really, that's money that you can't really use to grow your wealth. Now, I'll talk about unproductive debt more in the next slide. So when you're building wealth, you also want to take a long-term approach. So building wealth will take time, and it also requires discipline. So markets will fluctuate, but if you have a well-diversified investment strategy, this will pay off in the long run. So building wealth will require patience, and it won't happen overnight. You will have to be in it for the long haul. It's never too late to start, of course, but always the earlier you start is better. So if you commit to doing something, you're going to have to stick with it, and you're going to have to be disciplined. The value of your investments will rise and fall, but you should not be tempted to get rid of an investment if it's in a down period or in just a transitory period, with, say, it goes down with the overall market, unless there is a fundamental change that's going to affect the long-term prospects for that investment. Let's say they have some regulatory change that prevents, let's say a company that you invested in, there's been some regulatory change. it's going to significantly impact our revenues, then you may consider getting out of that investment. But if it's just an overall trend in the market, you may want to hold on to it because it is likely that investment will recoup its loss. And you should never, there's a saying in investments, is you shouldn't try to time the market, rather you should try to spend time in the market. So a good example of this is at the beginning of the pandemic in 2020, when, you know, it was seen that the pandemic was basically worldwide, equity markets just totally tanked. They fell sharply. But by the next quarter, markets started to trend up and they managed to recoup their losses within a year. I mean, now markets are down again, but we know we have some headwinds with the war in Ukraine and, you know, the high inflation and, you know, expectation for global growth. But basically markets will fluctuate over time, but you have to, like I said in the previous slide, you have to be in it for the long run. So you also want to consider simplifying your lifestyle. This may be easier said than done. So you want to look for ways to cut costs and reduce non-productive spending. And instead, you want to focus on seeking opportunities for investments. So, like I said, easier said than done, simplifying your lifestyle, because we all have these little luxuries that we are used to, and those are going to be hard to give up. But you just really want to look at your budget and identify any spending that can be channeled into investing. And you want to try to live below your means. And instead of increasing spending when your income increases, especially if you're already established a comfortable life on your current income stream, instead of increasing your spending, like let's say you have a salary, you're living comfortably off that salary and you get a raise, you don't have to live a more lavish lifestyle, but instead you may want to increase your savings and increase your investments. Now, all of this doesn't mean that you should deprive yourself of the basic things that you love. For example, if you enjoy going to Starbucks to get a coffee, maybe consider cutting back on how many times, on the frequency of your visits, and not cutting it out completely. Or you can look for other areas in your budget to compensate for you getting that coffee a few times a week. Or you can even look at, hey, investing in a fancy coffee machine, and over time that would offset the cost of you going to Starbucks all the time. But you know, when you buy this fancy coffee machine, you want to make sure that it's not too expensive and it's also within your budget. Okay, so now we will look at debt management. And this is, I think a lot of people sometimes struggle with this because they get stuck into a pattern where they're overwhelmed with debt. Debt is sometimes a necessary evil, but you have to be smart about it and make it work for you. It's important for you to carefully manage whatever debt that you may have. So first of all, only engage in productive borrowing. So you only want to purchase things that can build your wealth. You want to borrow to invest. Now, if you borrow to invest, we call this leveraging sometimes. You want to ensure that whatever return on your investment is higher than the cost of borrowing. So let's say you borrow at a rate of, I don't know, let's say 8% on an investment that you only expect to return you 8.5%. You have to ask yourself, does this really make sense? Do I want to go through all this just to get a 0.5% return? And also other forms of investments, like you could borrow for a mortgage. And when you borrow for a mortgage, usually you're borrowing to buy a home or invest in some property. And this way you are building long-term assets. And you're also sort of putting those funds that you may have been using to pay rent, you're putting that into a mortgage. So you're putting that into long-term assets. Or if you may have a small business and you may be interested in growing your business, there may be something that you want to expand your business and you require a loan to do so. But again, just make sure that if you're expanding your business and you want to borrow to expand your business, you want to make sure that the expected return is going to be more than the cost of borrowing. And you should avoid consumer borrowing where possible. So you really shouldn't be borrowing for travel or furniture or school fees. And this might be a little controversial, or cars. You really shouldn't borrow for cars, because cars are depreciating assets. But these are typically things that you should save for and not take out a loan for. Okay, so you want to also shop around for the most favorable borrowing conditions. And you want to look at lenders that are going to give you the lowest interest rate, the best repayment conditions. And, because some lenders, they want to charge you a penalty if you repay early, or they might limit the extra payments that you can make in any given year or any given time period. Some lenders, even if you want to make a payment or pay down the loan, they even require notice on it. Like, you can't just go in the bank and go pay down. You have to give them notice. I was speaking to someone the other day, and they mentioned that the bank required 6 months notice for them to pay off the loan, which is kind of ridiculous. But yeah, so you want to make sure that you get the best repayment conditions, and also that you read the fine print and look at any special clauses. Next, you always want to make reducing debt a priority. That can sometimes be burdensome, but if you seek to pay off higher interest loans and reduce your overall cost of borrowing, remember, if you are consistently paying off debt, you're not saving and you're not investing and you're not building wealth, sorry. So you should seek to pay off higher interest rate loans to reduce your overall cost of borrowing. And that is going to basically increase your overall net worth. Remember, net worth is your assets minus your liabilities. So when you have debt, that is a liability for you. And and sometimes it can be a costly liability. So in particular for credit card debt, you don't want to get stuck in the cycle of making just the minimum payments. Usually I treat my credit card almost like a debit card. So if I make a purchase, and especially if I make a large purchase using my credit card, because they give you those lovely points, I pay it off almost immediately, and I check my credit card balance a couple of times a month, and I do it down to zero, because I'm not relying on that short-term borrowing in the bank. I only spend what I can afford. And also, you may even want to consider funding your credit card before you make a big purchase. So put money on the card. If you will have to buy a plane ticket, or if you want to buy an expensive item, you put money on the card to cover the cost of that item, rather than using your limit. And credit card companies, they see you paying that minimum payment on time, they will keep increasing your limit, and that can get you stuck in that debt trap. So you also want to set a borrowing limit, and you want to know, how much debt do I want to have at any given period in my life? You should always strive for zero. We all want to be debt free. That's the dream, but sometimes that's not always possible. But what you don't want to do is, you don't want to have a mortgage, a car loan, and consumer loans. You don't want to have all those things all at once. If it's necessary to borrow, you want to make a commitment to only borrow for the things that you need and the things that will help you grow your wealth. Okay, so now we will look at some investment vehicles. There are various investment vehicles available that will help you build and grow your wealth. Most of these that I'm talking about will be specifically from the perspective of the Bahamian market. Now, the Bahamian market is mostly dominated by fixed income investments. It's relatively small. We have a small equity market, but it does tend to be much less volatile. So I'm just basically including in this list traditional investments, but also some that are less conventional. Some of these investments will carry more risk than others, but again, you have to go back to your risk tolerance. Usually the non-traditional investments are the riskiest, and they require patience and speculation and sometimes knowledge. Like, you really have to know what you're doing and have to watch them very carefully. So first, we're going to look at fixed income. So fixed income investments, these investments include government bonds, corporate bonds, and preference shares. And usually these investments provide us predictable stream of income. So let's say, for example, in the local market, you have government bonds that provide you with a fixed coupon. You also have corporate bonds and preference shares. Corporate bonds, the same thing, they provide you with a stated interest rate. And then you have preference shares with a dividend, a stable dividend rate. So these can provide you with a predictable stream of income. So you know, if you have $100,000 in a flat bond with a 5% interest rate, you know you're going to get $5,000 a year in income from that bond. But fixed income investments do typically tend to be, of all this list, they're typically going to be the lowest risk, but you also have to be mindful that issuer risk is important. So usually we say government bonds are fairly low risk, but corporate bonds and preference shares, depending on the issuer, you have to make sure that you review the issuer's capacity to repay you. Because if they miss one payment, they're technically in default. And so you would have not only lost that predictable stream of income, but potentially your capital is also at risk. Next, we have equity investments, and equity investments tend to have less predictable returns than fixed income investments. So let's take this is an extreme example, but equities can have unlimited gains. So you can double or triple your investment in a given period of time. But on the flip side, the company that you invested in can go bankrupt and you can lose everything. Your investment can go down to zero. Equities represent ownership in a company. So example of these investments include common stock, and that stock that is listed on a stock exchange, so a public companies, and then private equity. So there's someone who does not list publicly. And this could also be, you know, someone like a friend or a family member or someone you know whose business that you invested in and you got shares in this business. So that would be considered private equity. So mutual funds. Mutual funds are a financial vehicle made up of a pool of money collected from many investors for the purpose of investing in various securities. So mutual funds have various strategies. So it could be money market, it could be bond fund, it could be an equity fund, or it could be a balance fund, which is a combination of money market bonds and equity investments. And mutual funds may be most suitable if you're just starting out on your journeys to build wealth and to build an investment portfolio. And you have a smaller capital base to work with, because usually they require a relatively minimum amount of capital. But remember, I know some people often say, you know, I don't have enough money, I don't make enough money to build wealth or start an investment portfolio. But remember, you have to start somewhere, and there are financial vehicles available where you can start with as a little as $100 to help you build and grow your wealth. And then once you grow your wealth through these vehicles, then you can start investing in other investments that require more capital. So next we have real estate, and real estate is ownership in real property. That can include residential property, commercial property, or vacant land. So for real estate, you may have houses or apartments to rent if you're lucky. And, you know, currently a lot of people have gotten into Airbnb. So if you have a nice property, you might want to consider listing it for a short-term rentals. Or you may even be able to flip a property. So if you find maybe a dilapidated house or something that is in drastic need of an update, you may buy that at a fairly low price. And I'd say low is relative because in the Bahamas, the real estate prices are ridiculous. But you could buy it low and then refurbish it and sell it at a high price. So that's something to consider. But of course, this is more capital. It requires more capital if you're, especially if you're doing it by yourself, or you may even have to take out a loan to do this, or maybe you can find friends or family and you can start a pool so that you can afford to do this. And you can also speculate on vacant land. So you can buy land in a particular area in hopes that it will be built up over the next few years and the value would increase. But this requires specific knowledge of the real estate market. So if you're skittish about that, then maybe not do that. But in the Bahamas, like I said, property prices continue to increase, and basically on this little island of New Providence, we are basically running out of viable land to build housing. So it's not a bad investment if you have the capital. And then we have other investments, and these are non-traditional investments such as art, hedge funds, commodities like gold and oil, as well as currencies like Bitcoin, for example, which is a cryptocurrency. So it's quite different from the fiat currencies like the euro or the pound. These investments, again, like real estate, what I mentioned about the real estate, they typically require you to have specific knowledge about the market. So they tend to be more speculative and a bit more risky. So you don't, like commodities trader or currency traders, they're like sitting at their computers all day just watching move, doing arbitrage calculations. So it's quite a lot of speculation. And it's also very risky, but if you have the capacity to take that risk, it's also something that you may want to consider. And then we have like art. Art doesn't really give you any income unless you like rent it out. But it can provide a store of value. It's meant to sort of like fight inflation, I guess. But I guess you have to know the right piece to pick. I don't know much about art, so I'm just speculating here, but the right piece to pick. And so it's supposed to grow over time. I know you hear all these things in the news about people selling painting for like millions and millions of dollars. So yeah, that's something that you can consider as well. Okay, so other non-traditional investments, and you don't have to have like a lot of capital. Like I say, if you're not really interested in the traditional stuff, you want to think outside the box. As an example is like, say, a vending machine. That's something that requires a very small amount of capital, but it can give you a steady return if you find the right place to put it and the right snacks to put in it. And so this is like I said, you don't have to always be like these grandiose investments. You can start small. Some investment vehicles may be more suitable for you depending on your level of capital and your risk tolerance. So you just want to ask yourself, do I have the capacity to invest? What do I have the capacity to invest in? Do I have sufficient capital? And also remember, I mean, like I mentioned, our local market is fairly limited, but you do have the option of investing abroad. And for persons who have more capital, who are lucky enough to have more capital, they're able to have individual investment accounts that they can convert money and purchase US dollars to invest abroad. But other persons, they may not have that as much capital, so you can explore. We have our local investment firms that have global funds where you can invest. You only need a minimum amount of money to do so. And the fees are lower than if you were to go directly to the central bank to convert dollars. So while our local market is limited, just remember you're not limited to the local market, and you can invest abroad. But of course, you'll have to pay the fees and the taxes. to convert these monies. And also on that, fees, I didn't really speak about fees, but that's something important to consider when you are investing. So you always want to be mindful of the fees, and you want to make sure that the fees don't wipe out or are significantly cutting into your returns. So you always want to look at your returns from a net of fees perspective. So what is my return after fees? Because if you say you have a portfolio and your portfolio earned 7.5% last year. So you really rate like I earned 7.5% last year, but then you paid your broker or your investment manager, you paid them, this is high, but 2.5%. So really your return was only 5%. So your actual return, your net of fee return was lower than the pretty 7.5%, which you were really happy with. Okay, so we've reached the end. So I'm just gonna go through some key takeaways from the presentation. So first of all, you want to save and invest as much as your income as possible. So you want to make savings a habit. If you are spending too much, you are not saving. And savings is your vehicle for starting to invest. So remember that. So everything always boils down to how much you save. You want to identify your investment goals and review them periodically. So it's important to keep track of your goals and review them to ensure that they still work for you and for your circumstances. So you may have had some significant life changes when you started your investment portfolio. You may have been single, but now 10 years later, you have a spouse, you have kids, you have a mortgage. So it's important to review your investment goals, especially as your lifestyle changes. And you want to practice discipline. You want to stick to your plan and you want to invest in a consistent manner. So it's important that you're not always haphazard with your investments. So next you want to be ambitious but realistic. So remember, the sky is the limit, and you should always have the mindset that you can grow your assets. But you still have to recognize that unless there are some extenuating circumstances or you come up with a really, really, really good idea, which you can, I'm not saying you can't, but it is likely that you won't become a millionaire in a matter of months. So you start out with $1,000. I'm sorry to tell you, you probably won't be a billionaire by the end of the year. I stand to be corrected, but you just have to be ambitious. You have to know that my wealth can grow, but be realistic about how much it can grow in any given period of time. Rome wasn't built in a day, so your portfolio will take time to grow. And you want to research and ask questions. You want to read and consult with others. You want to ask questions about the expected returns and the fees of your investments, because the questions that you ask and the answers that you get can make the difference in you making a smart investment decision. So you don't want to leave any stone unturned, and then down the road you find out, oh, well, this happened and you didn't ask the question because you overlooked it. So you want to ask questions and you want to be mindful of everything you need that can help you make a smart investment decision. Next, you want to always be on the lookout for new opportunities that align with your goals. You want to be open for new opportunities and you want to be mindful and goals oriented. So for example, if you decide that you're interested in real estate investments, maybe you want to start an Airbnb, or maybe you want to rent out a property, or maybe you want to get into the business of flipping a property, you want to read, you want to consistently read the online property listings or the newspaper listings to see if you can find a viable property. And lastly, the process is not perfect. Even the experts make mistakes, so you must always learn from your mistakes and reset. So sometimes you may make the wrong move, but you have to identify why and move on and not dwell on it, but make a commitment to yourself to not repeat your mistake. And you want to say to yourself, okay, I did this because of this reason, and it didn't work for this reason. So you know that you don't want to repeat that mistake again. But building wealth, it is a process, it is a journey that you can start. You can start with as little as you want, you can end with as much as you want. So you just have to have commitment and believe in yourself. I know I'm sounding a bit mental here, but you have to believe in yourself and, you know, believe that you can do it. And there are various vehicles available out there. There are also various ways that you can find more information on the internet. You just have to be mindful of sources. So you just have to listen and to be aware and make that commitment that you want to build wealth and you want to become more financially secure. So thank you for your attention. I'm open to questions. I'm not sure if any of you had questions. I saw some weird things happening on the screen, but I wasn't sure what it was. But if you have any questions, you can feel free to ask.
Hi, Lachelle. Can you hear me?
Yes, I can.
Hey, okay, this is Chris Stonewall. We have some questions in the chat, so I'll just read the questions to you and you can answer that way.
Okay, no
First question, what fixed income investments other than government bonds are presently in the local market available for sale?
Unfortunately, there are not that many. The market has been pretty quiet for the past few years. The only investments, regular investments, are government bonds. We had, I think the last fixed income offering we had was the Nassau Cruise Port offering, and that was in 2020. So the local market has been pretty quiet on that end. If you are interested in fixed income investments, or you just want to park money for a while, there are most of the brokers have bond funds, but other than government bonds, unfortunately, there have not been any sort of new fixed income offerings in the local market.
Okay. I do agree, though, there really aren't many options, though. Next question, what options are there to access the international markets to diversify your portfolio?
Pardon? Can you repeat that, please?
Sure. It says, what options are there to access the international markets to diversify your portfolio?
So there are, we have global funds. So some of the investment houses have global funds that you are able to get into. So it's a mutual fund, but it has exposure to the global market. So usually you have to pay a fee, of course, for the government stamp tax. And then there is also, you can go directly to the central bank and apply to be there. They have something called the investment currency window. And you can go there, but of course you have to pay the 5% stamp tax, 5% conversion fee, and the I think it's 1.5% stamp tax. So it is pretty expensive. So for persons who want to go get exposure to the international market, I would say you can use use one of the local mutual funds that has exposure to the international market.
Okay, great. Let's see. Oops, sorry, questions coming in and like moving the chat. So give me 1 second.
Okay.
This question, what is a good 5-year investment plan with good return?
A good 5-year investment plan with good returns? Like what? I guess you have to define good returns. It's not going to be anything that's going to be exorbitant. If your risk is low, then you may want to consider a short-term government bond. They've been giving pretty good rates. Of course, you have to, because the banks aren't giving you anything. If you take a chance on a stock investment that you expect to grow in 5 years, you can do that. But it's all based on your return expectations and your risk tolerance. So I would say if you just want your money to grow and the banks aren't paying anything, you may want to consider putting it in a mutual fund and just letting it sit there and grow for a bit. Again, it's not going to be anything, any outsized or large returns, unfortunately. But in the current market, that's your best bet. But you have to look at, what is my risk tolerance? Do I want to take a chance on an equity investment, or do you want to go into, do you want like a steady return where you can consider fixed income? I saw somebody posted learn the Forex markets, and you can learn the Forex markets. But I don't know. I'm not exactly sure how you invest with them by going. You'll have to somehow have the central bank involved. I mean, you can learn about the markets, but that's also very speculative.
Okay. Sorry. So for persons who can't afford it right away, are there steps that can be taken so the individual can start their investment portfolio?
Oh yes, absolutely. So if you cannot afford to build an investment portfolio right off the bat, there are low options that require minimum investments of as low as $100. You can go into a savings plan and earn a bit of money, and then you can build up your wealth over time. And then maybe you can jump from the savings plan to a mutual fund, and you can jump from the mutual fund to an investment portfolio. It will take some time, but it's always important to start from somewhere and not just say, well, I don't have enough money, so I don't want to start to increase my wealth. So yeah, so I mean, it may take you a while, but it's better than to have something than nothing at all.
Very good point. What's next? What advice would you give someone exploring investing in cryptocurrency?
I do not have much advice to give. I know we have a session on cryptocurrency in 2 weeks, so I think that it's best that you probably wait for that. Cryptocurrency, I think it was down with all the markets was down, so it's speculative. It's something new. I think it's something that everybody is interested in, but definitely check out the session in a couple of weeks to learn more. And I think that it can be it's something new. It's something that is always on the news, so a lot of people are interested in it, but it can be speculative, but a lot of people call it like the currency of the future. But I definitely say that you should educate yourself about it, and if you want to maybe play with a little capital on it, maybe put a small something in it, but I wouldn't say put all your assets in crypto right now, especially if you don't understand the mechanics of it. And first up, and definitely check out the session in 2 weeks.
Okay, great. What is the average return on a bond fund, and what costs are involved?
It depends on the issuer. Now, I don't want to be, I don't want to toot at my own company, but I can just speak for example, our bond fund, I think, earned about 4.35% last year, and the management fee is about 0.5% per annum. But your returns are always reported net of fees, so you don't see. So we don't give you a gross return. Like, we don't take money from your investment, so your return is always net of fee. So you can look at something around in that area. So it shouldn't be anything. But you don't want to have anything. You don't want to have anything that has like a 2% fee or something, because that's definitely going to eat into your return.
Okay, if you can't afford it, as in you're in debt, do you agree one should not invest?
I think that you should try to get out of debt first. I think that should be your top priority. Basically, I think because you don't want to have this debt hanging over you and you're taking money to like buy stocks and bonds. You want, maybe you try and say, okay, I'm going to earn a high return on this and I'm going to use that to pay off my debt. But I think that you should always make reducing debt a priority. Otherwise, it's going to keep growing and it's going to become burdensome. And it's not a good type of growth. It's going to be like the interest payments, the principal, the longer you take to pay it off, the more principal pay, the more interest you're going to pay, because you pay, the interest accumulates. You just want to pay it off as soon as possible and give yourself that breathing room. And you should, once you become financially stable, then I think that you can look into investments. But definitely try to pay off your debt first. If you're burdened with all this interest payment, try to get rid of them and try to dwindle it down to a manageable amount. Then you can start making small investments, because you can save and pay off debt at the same time. But if you are overburdened with debt, you should definitely make that a priority in your financial journey. I don't think that you should want to focus on, investing and making money. I think you should focus on paying off the debt first.
Okay, next we have an interesting question actually. I mean, I know the answer to this, but I'll let you answer it. It's just one of those things that, I guess you wish you could do, but you can't. But so someone's asking, why can't we do shorts and puts on the BSX? Oh,
you have to talk to the securities commission. Yeah, I don't think our regulations allow us to do shorts and puts, and the market is not that. I think we only have like 20 stocks on BSX. And the market is not that liquid. You have a few liquid securities, so I'm not really sure where you would even, which securities you would even want to short or whatever. So the market is not that not very liquid. I don't think the regulations allow for us to put puts and shorts on BSX. And then sometimes the trading volume is so low, so it doesn't really make sense. Like say if you can short stocks that are on the NYSE, which has like huge trading volumes and a huge amount of shares outstanding. So in the local market, I don't think that's even if it was allowed, I don't think that's feasible.
Yeah, I agree. It is a very interesting question, though. I mean, it's something we would like to have for our capital markets to be that developed, but unfortunately, we're just not quite there yet.
Not there yet. Yeah, I see. He wanted to short cable a few years ago. Yeah, unfortunately, we're not allowed to do that.
Yeah, I'm sure he's not the only one.
Yeah.
But another question: how can Bahamians invest in gold or silver for generational wealth?
Well, you can, like I mentioned, if you can go to the central bank and you can get permission if you wanted to invest in physical gold like bullion or just like gold ETFs or whatever. You'd have to go to the central bank. Now, if you want to invest, like maybe you could keep gold in your jewelry case, and hopefully somewhere down the line, your ancestors would have some means of selling them or putting them in the market. But again, if you want to invest abroad, and gold would be considered international asset, so you need US dollars to purchase it, you would have to go to the central bank to get permission to convert to US dollars. And they've been pretty good about it. They had closed the ICM program during the pandemic to keep our US dollar reserve steady. But they opened it in the last quarter of last year. And they've been pretty open to approving persons for investments, but you also have to keep in mind that 5% conversion. You do get 2.5% of that back when you repatriate the funds back. So yeah, so you just have to be mindful of that. So if it's something that you want to do, you can definitely do it. You just have to be mindful that in our current environment, where we're not really allowed to invest abroad without central bank approval, then you would have to go through the ICM program and pay the 5% conversion fee and the 1.5% stamp tax to do that. But yeah, there's gold bullion available in the international market, and there's also gold ETFs that are available that exactly track the price of gold. And usually ETFs are more low cost.
Great answer. Okay, I think that's all the questions from the chat so far. So does anyone else have any questions? You can drop it in the chat or raise your hand off. I think you should be able to just unmute yourself and speak. So I'll give anyone else a chance to ask any more questions. Okay, one more question about gold. Someone's asking, what about Bahamian coins?
But
Asking,
like
I guess
anniversary.
the central bank issues those gold coins and whatnot. I guess what's your thoughts on that as an investment?
Yeah, it has. Do you know anybody? I mean, I don't really follow that market closely, but I know that they do issue coins. So I guess like in a few years, if you keep hold of them long enough and you want to resell them at a later date, they could be worth more money because they would have sentimental value. So I mean, yeah, if you invest in them, I don't know. I don't have any information on any sort of historical values, like what is the coin they issued 10 years ago worth today, but I do imagine that it would have I do imagine that it will have some sentimental value for someone who would want to pay more for it, who want to buy it from you at a higher price than what you paid for it. I thought somebody had something about $10, something in there. I missed it and it just popped up with me.
Yeah, someone's asking me if you can chat a little about the sand dollar and its future uses, I guess.
I don't really know that. I mean, I know that the central bank had issued the sand dollar, and I know that they have been trying to expand the uses of the sand dollar, especially in the Family Islands where they are basically underbanked. I see that they have at the central bank, you can even buy Bahamas government bonds with sand dollars. I see like I passed a couple places who accept sand dollar as payment, but it's not really that widespread yet. But I think that the central bank is trying to get it to be more widespread. And especially it's going to be important for those people in the Family Islands where all of the major banks have left. So they're basically underbanked, or their fees for them to do any sort of banking transactions are particularly high. But I do know that the central bank, they are really pushing to get the sand dollar to be of more widespread use. I do think that they can do, this is just my opinion, a little more about educating the public about the sand dollar and how it can be used, because it has been out for a couple of years, but it hasn't gotten the widespread use that I think they were hoping for. But I mean, we have gotten some international attention because of it, because it's basically like we're one of the first central banks to issue a digital currency. So I think that if they can sort of get it into more widespread usage, it can become a viable, have viable use in the local market. I think Nicolette, thank you, recommend having a digital wallet on one mobile phone. What do you mean digital wallet? Like with cryptocurrency and stuff like that? I know I have like, or Apple Pay or something. I don't know. I'm not sure. Are you referring to like for cryptocurrencies, or just for to how to track your credit cards and whatnot? Yeah, if you could expand on that, that would be
good. But if not, remember our session on cryptocurrencies is coming up, so we can definitely go into more detail there. But oh, okay. So she's saying for
digital
currencies like sand
dollar. Yeah, if you are interested in cryptocurrencies, I should say one that the leader of physics uses. That's the $10. I don't even, is that even in like your digital wallet? I'm not sure. I'm not even sure. Like, I don't know if they've like done, I know that they've done some, oh, okay, I understand what she's saying now. So she said the one that they use for the travel visa. I think that we're definitely gonna be moving forward to that way in the future, but I don't know if we've like sufficiently rolled out, especially in the local market. I don't know if we have sufficiently rolled out all of those things here, but yeah, but I mean, after the pandemic, a lot of things were switched over. I mean, we got all of these new apps. We have like Craven and everything for delivery. So a lot of things change really quickly. So I do think things like a digital wallet would be very useful in the future. But right now, there's not a lot of enough widespread usage in the local market. But I do think that it could be useful, useful going forward. I'm trying to remember the name of the Canoe. Is that what she's talking about? Canoe? I think it's the Canoe app that she's.
Yeah, I think that's what it is.
Yeah, the Canoe app. Yeah. So those things are actually really exciting to me because you don't have to. Yeah. Yeah, she said her debit cards were fine. Yeah, but I think that those things are really exciting to use, and you can just, you know, tap and have all your money in your phone. It's also kind of scary if somebody hacks or steals your phone, they can have access to that. But yeah, I think that that's somewhere, it seems the way that we're moving towards. Yeah, but my debit card also works fine.
Right. Okay, I think that's all the questions we have, and I know we might be a little bit over time, so I guess if anyone else has any questions, then maybe you can ask them at the next session if needed. But for right now, I'll pass it back to Jerome to wrap up.
Sorry. Thank you very much, Lachelle, for joining us. Thank you for your insight and your valuable information. You know, I definitely appreciate it, and I think a lot of us in the audience appreciate it as well, and we'll put a lot of these lessons into practice. So, thank you very much. Thank you everybody for joining us. Lachelle, I don't know if you have any last words. If you do, please share.
Yeah, I mean, I don't really have any last words, but well, yeah, I guess I do. I just would like to say, you know, you don't have to have a lot of capital or a lot of money or a big inheritance to start your journey to build wealth. It's always, you can start small and you can build up to it. And you don't have to have any sort of grandiose plans to have millions and millions of dollars, but even if you can just get to a place where you're financially comfortable and maybe you have a small nest egg, you should strive towards that. So remember just to continue to educate yourself and to try and save as much as you can and invest those savings so that you can earn some return.
Thank you. Thank you, everybody. And we'll see you guys next week, Thursday, as we discuss the topic of real estate and home ownership. So thank you. See you next week. Bye.
Hey, everyone.